closing out. To close out your short spread, you'll need to buy the short 65 put for the current price of $3 and sell the long 60 put for the current price of $1 for a net debit of $2. $3 minus $1 equals $2. The total cash you'll pay for the spread is the $2 debit times 100 shares, or $200. Since you originally received $300, your profit will be $100. As any bull put spread is moderately bullish in nature, an increase in the underlying stock price should be expected for profits to occur. At expiration, if both options are out of the money and have no market value, you'll see the maximum profit. Again, this situation should occur if the underlying stock closes at any point above the higher strike price with no action needed on your part. What about before expiration? You may find that a bull put spread has no value or very little in advance of expiration if both puts are far out of the money. If you want to close out the spread and realize your profit potential at this point, you would need to buy it in the marketplace. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.